I'm David Day with Eckard Enterprises. I'm the business development manager, and I'm here today talking with Troy Eckard, the CEO and manager of Eckard Enterprises. And we're here to talk about mineral market and some questions that revolve around that. And Troy, the first question I had is, why do you think mineral prices will not go down any further from where they are now?
David, that's a very good question, and I think that's a very subjective question because at the end of the day, I think the price paid for minerals is completely irrelevant based on a number of factors. The first factor is what are commodity prices? And there's a lot of correlations that people have between the price of oil or the price of gas and what minerals should be bought for or acquired for. But there's a lot more that goes into it than just the commodity price. So for example, in our case, as we look at minerals to buy in several different basins, our main target being the Anadarko Basin, we're looking for a price that we can pay for a mineral based on how much activity is currently existing on the mineral. Do we have producing wells? Do we have drills that are uncompleted? Who's the operator? Do we feel confident that operator has hedges in place? They have a good market to sell their oil and gas to? Are we going to get shut in? We also are looking for which company normally has the practice of infill density drilling. So when we look at a mineral, it goes far beyond just a kind of an appraisal value that says, hey, this mineral compared to three other basins should all be 25,000 an acre. What we're finding is from basin to basin to basin, the parameter or the range of mineral pricing is all over the board. But to answer your question specifically, it is my belief that we are probably at or near the very low price for mineral acres from sellers who want to create some liquidity. And let me tell you why. It appears that many of the traders that trade minerals, they buy them with the intent of selling them immediately. They are probably tapped out on capital. They spent their money the last 3 or 4 years. Now they're faced with either servicing debt, paying back private lenders who gave them the money, or simply creating liquidity for their own account. These particular individuals have a lot more pressure to sell than, let's say, what I call a traditional mineral owner. A traditional mineral owner is somebody who has had it in the family, they've inherited it, it's been part of their lineage. They're not going to sell their minerals today at these prices because they don't have to, unless there's just a financial emergency, putting their mother into a nursing home or paying off a farm or a tractor or something like that. It's liquidity for capital expenses. But these traders are faced with a tough dilemma. They bought with the intent of flipping or selling them because they saw a lot of drilling rigs and they saw a lot of permits, and they felt like the entitlement, the value from a non-producing mineral to a producing mineral or a mineral that had permits on it was going to be higher. They could buy for $5,000, sell for $8,000, and do it in 6 months or less. That whole market's been gone. As the rig counts come down, that whole playing of that card of hands is done. So today they're looking at their portfolio saying, how do I survive? How do I pay my bank or my private lender? How do I create cash flow? Well, they're going to dip down into their basket and they're going to say, what's the very best mineral I have that somebody will buy, considering there's virtually no buyers in the market today? Well, it's going to be their mineral that has not one producing well, but 2, 3, 5 producing wells, maybe 4 undrilled wells that were drilled but uncompleted. And now they're going to be faced with selling their very best inventory. I think today what we're seeing is we're not at the bottom yet. I think the bottom comes in June or July when they receive their first royalty check with really low oil prices. And at that point in time, the squeeze is on. So I think we're probably within 30 to 60 days of the bottom. I don't think we're there yet, but there's not much left. I mean, we're scraping concrete. We're scraping the bottom of the barrel at this point, but we're not quite all the way to the bottom just yet.
Okay, and why would a traditional mineral owner not want to sell now?
You mean somebody who's owned it in their family and lineage?
Yeah.
Well, back when the land was first acquired or bought under the Land Act, minerals were not really considered a severed property. They came inclusive. I got air rights, I got the surface rights, and down below I got the mineral rights. When the evolution of realizing minerals could in fact be recognized as a separate deeded asset, those landowners recognized that I could keep my farm and my ranch, but I could sell the minerals off. And I didn't have to sell them all off. I could sell them in increments. I could sell them like a dozen eggs, 1 egg at a time. So today, the only traditional mineral owners that have had them in their family that are selling is like 3 months ago. We had a call from a guy who said, look, my mom owns 300 acres of minerals. We got to put her in a nursing home. We don't want to lose the home place. We don't want to sell our minerals, but I need to sell 40 of the 300 acres in minerals to put enough money aside to take care of her memory care unit. I don't want to sell, but I have to sell. So we bought his minerals at a very good price. He was appreciative that we closed. Now he has the money set aside for his mom. Those are still going to be the instances that we deal with. But for the most part, they don't have to sell because the farm or ranch has been paid for. They inherited it. They passed it on. Unless they've done something crazy, put themselves in debt, they're looking at the price today saying, I wouldn't take less than 10 or 15,000 an acre. And I'm looking at the market saying, well, I wouldn't pay you more than 7 or 8 or 9,000 per acre. So we've got a disparity. I'm not finding in our effort, the money we spend every month, we're not finding the same sellers we did 6 months ago. We're finding those people saying, it's so nice to meet you, call me in 12 months when the prices get back to normal. So there has been kind of a normalization within the market from those traditional mineral owners.
So when prices go back to $30, $40, $50 a barrel, what do you expect the mineral prices to go to?
Well, here's how it usually happens. So true hardcore mineral investors invest all the time because they invest based on economics. When the economics are clearly indicative of a declining commodity price, prices will continue to trail down, but they're slow. If oil plummets, minerals don't start dropping off for 90 to 180 days because it takes them getting that sobriety of that first low royalty check to go, whoa, what happened to my check, right? The flip side is a little bit different. So the recovery in prices is much more straight up than it is more of a U-shape. And here's why. Because all these traders and flippers who never are really in the mineral business, they're just running amok looking for a mineral they can buy and flip for 1.5, 3 times the price. When they see oil prices running back up to $30, $40 a barrel, the unsophisticated investor is going to say, oh, oil's coming back up, I should get in. Well, they're going to go buy it for 10 or 15,000 acre. They're going to sell it for 20 or 25,000 acre. And I think that we will see competition for those minerals as prices rise, double, triple, and quadruple. So let's just say it like it is today. Today, I think there's 3 or 4 buyers in the Oklahoma market. If we see $45 oil, there'll be 20 players. But the other side of that coin is there's going to be a shrinking of opportunity because as the drilling rigs have been laid down, we're down to 13 rigs in Oklahoma. You can't just follow the drilling rigs. You can't just go after the newly completed wells because that number of opportunity has shrunk. So you have a whole lot more buyers trying to buy much fewer acres, and it's going to exponentially drive prices much higher than they should be. And that's where we might want to take a breath and play in a different basin, or we might have to tighten our parameters on what we buy. We will always make money buying minerals. It's just a matter of how we go about it. But I do think that the prices will rise at $35 to $45 a barrel, and I think that'll occur sometime after September and October. We have about a 90-day window. We should be buying like an octopus with 8 arms every mineral acre we can buy today.
Thank you, Troy. Appreciate your time, and thank you for listening. We will have many of these follow-up questions. We're getting many questions on it, lots of opportunities, and look forward to talking with you soon.